I'm going to sort of tee up the questions for this panel. The large question, of course, is the strategy review. Both Europe and the US are undertaking formal strategy reviews. I think everybody else is rethinking their strategies. We have a panel here which I think combines tremendous academic and practical experience, and nobody here works for a central bank. So I think what I've tried to put together is the ideal set of consultants that any central bank could ask for on what the heck should we do for our strategy review. And I want to emphasize the word strategy. John Taylor keeps reminding us it's not a rule, it's a strategy. The rule is not intended as a mechanical thing, it's a foundation for a larger question of strategy. And John, if John's won one thing at least, that they're using the right word, strategy, for it. As I see it, the US just came off. What are we doing again? Well, we just came off a strategy review, which was an admirable extended process, deliberative process, came up with flexible average inflation targeting. My view of that is that it is a almost ideal new Keynesian forward guidance defense against the prospect that the zero lower bound risks deflation and stagnation. Unfortunately, it came into place just at the moment when that was not the issue. And as you know, about a day after the ink was dry on flexible average inflation targeting, the inflation surged past the target of 2% to 8%, and then came down again, something that I think I have a great explanation for, but will not say a word about that right now. At least, this is a major failure. 2% target, 8% inflation, something went wrong. And to their credit, central banks are looking at what the heck went wrong and what should we do differently. That's what a strategy review is about. And I'm sure we'll hear lots of opinions about that. Now, what is the new strategy going to look like? What are some of the questions that we want to ask? First, I think we will probably end up in something more reactive than forecast. Rather than here is where inflation is going to be for the next 5 years, here is what we are going to do with interest rates. The forecasts were so completely wrong. I think we have to face that fact and phrase strategy data dependent rather than time dependent. In some sense, how are we going to react to events? Now that does bring up the big question, rules versus discretion. Rules, strategy, is it a numerical how we're going to do things, a completely listed set of what are we going to do, versus a looser strategy and some or more discretion about how we react to events. The whole point of rules, of course, is to give you solid expectations. But the other way of doing solid expectations is the Mario Draghi way. Not, I'm going to raise interest rates 1.50 times inflation plus 0.5 times unemployment, but rather, we're going to do whatever the hell it takes to get 2% inflation. Trust us, we're going to go there. Well, both are approaches, and I'll be interested to hear which way our panelists want to go. There's a deeper set of questions for the strategy that I hope we will address. The first, of course, we now must face the fact that inflation doesn't just come from monetary policy mistakes. It comes from other shocks. If you believe we got our inflation from supply shocks, then we darn well better start looking, measuring, evaluating, and thinking about how to react to supply shocks, rather than treat them just as a dog ate my homework excuse for why inflation came. If there are, as I think, fiscal shocks, the same thing must be true. It's not obvious that we respond to both of those shocks in the same way. It is certainly true that the next shock will be unforeseen, just like all the other shocks will be unforeseen. Perhaps, or the next situation will be unforeseen. Perhaps we'll be thinking about a grand sovereign debt problem. Perhaps we'll be thinking about stagflation. Who knows what it's going to be? So that leads for a question. Again, I'm asking you questions, guys, even though you can't see the question marks. Should we be having a detailed set of contingency plans, or do we want to construct a strategy that is robust to all the unforeseens? We need to face the limits on monetary policy. We've talked about these, and I just want to tee them up. In today's high debt world, higher interest rates raise interest costs on the debt a lot. Fiscal limits. Higher interest rates cause problems for the banks. I view that as a fiscal thing too, because the only problem with that is, well, then the government's got to come bail them all out again. So that the fiscal and limit. In Europe, higher interest rates cause sovereign debt problems. To what extent is that limit going to hit? And of course, if we have a fiscal inflation, higher interest rates cause fiscal problems, they pour gas on the fire. The deeper, and my last question is, let us face the fact we don't really know how this thing works. There's a doctrine and a presumption in central banking that there's a fairly mechanical relationship, higher interest rates, lower inflation, reliably, stably, mechanically, maybe with some log and variable lags to excuse the fact that that doesn't seem to be how it is in the data, but that's how central bankers believe it works. The one thing I know from 50 years of looking at this, and everybody on the panel knows as well, if we're honest, there is no faintly respectable economic model that delivers that result. How do interest rates affect inflation in every respectable economic model? That is contingent on fiscal responses, on the financial system, on other preconditions that are different in history and experience than now. In every model I know, higher inflation without a fiscal response to pay the interest costs on the debt has very big trouble lowering inflation, as an example. So, strategy. How does the strategy also adapt to the fact that we really don't know how this black box works? Well, I think I've teed up a lot of questions, and let's let the panel go at it. We'll go in right to left order. Athanasios first. Mickey and Charlie know that they have one slot, not two slots, because they're presenting one paper. Then John and then Larry.
Thanks, John. Wonderful to be here. Thanks for the organizer, and John and Mike as well. I'm going to start by saying I fully agree with you. We don't know. There are many things we don't know. But that should not stop us from trying to identify robust strategies that can help improve things relative to, just leaving things completely at random. I'm going to start by saying that since its founding in 1913, the Federal Reserve has been adapting its policy strategy from time to time and has been more open about this in recent years, which is a good thing. The ability to critically evaluate past performance, learn from mistakes, espouse new knowledge is the hallmark of a good institution. Now, we all know the history of the Fed, so its adaptation has not been uniformly positive. But in my view, studying the history and examining the last, I'm going to say 40 years relative to the previous 40 years, policy has improved over time. Following the successful disinflation of the 1980s and 1990s under chairs Volcker and Greenspan, the Fed has generally succeeded in fulfilling its mandate better than in the past. I think this is pretty clear-cut if we look at both actual inflation numbers. Here I show GDP and deflator and core PCE as two measures. And also if we look at expected inflation, these are 1 year ahead measures, not as long as the ones we've seen the previous panel, but we know that these measures have suggested some improvement in these regards. Now, this is until the pandemic, and the issue we have in the blips that you see there, it's a humongous blip in actual data, but more disturbingly, even in the expectations data, we have some concerns that something went wrong. Now, we know that the Fed eased policy forcefully in 2020, and this was appropriate. But it was late in normalizing monetary policy during the recovery, raising questions about the resilience of the policy strategy. And this is what I want to address today. Now, what has gone wrong has been discussed extensively, and in previous editions of this conference, for example, I was watching it virtually the last couple of years, in my view, and many other contributions. we've also seen today some of the inflation was unavoidable, could be attributed to adverse shocks. Some of the disinflation had very little to do with the Fed as well. So we've seen this discussion. But policy mattered as well. And in my view, monetary policy was part of the problem. The Fed got trapped in the forward guidance it provided about future policy, and it deviated from what would be expected if policy had been systematic. And we have seen a number of studies in the last 3 years with various papers looking at deviations from simple policy rules, documenting this quite well. So one way to describe this error is to just look at what happened in the last few years in just a couple of charts. The chart here is simply summarizing nominal interest rates, the Fed funds rate, and the 1-year OIS rate on the left panel. It uses the inflation swap rate at the 1-year horizon and the 1-year OIS to create a real-time ex-ante real interest rate. That's the red line on the right panel. And we can see what the problem is here. After the pandemic, the Fed uses discretion to peg the federal funds rate at 0 for too long, even as inflation and inflation expectations were rising. And with the Fed keeping nominal interest rates inappropriately low, real interest rates kept falling to more and more negative levels while the economy was growing. And this is the monetary policy contribution to inflation. Now, to figure out exactly how much of the inflation is due to that and not other things, we need a model. Again, I subscribe to I consider it a documented fact that adverse shocks contributed to a big chunk of what we have seen. Now, if you look at this chart on the right, you're going to notice that during the post-pandemic recovery, policy violated massively the Taylor principle. As inflation expectations were moving up, the Fed was engineering lower and lower real interest rate. It also failed to respect something much more basic. If you go back to Milton Friedman's 1967 presidential address, he had highlighted 2 things monetary policy could not do, and the first one was exactly this. I'm going to quote, Friedman wrote, monetary policy cannot peg interest rates for more than very limited periods. And it looks as if we did not have a strategy in place that would protect us against pretty obvious elements. We see here, real interest rates fell to really historic lows by some measures. What this experience illustrates is that implementing monetary policy with interest rates can be challenging. Of course, we knew this. There was a reason why Milton Friedman, decades ago, was suggesting that a robust, simple rule would actually be based on money growth. You control money growth, a K% rule will not create the instabilities that would be associated with this. But of course, with financial innovation in recent decades, we know that that's probably not the best way to do this, and we need to be operating monetary policy with interest rates. Of course, systematic monetary policy can be implemented and communicated with a nominal interest rate, but this requires adjustment in a systematic fashion. Policy must be informed by a well-specified reaction function. This is what I draw as one important lesson from the pandemic. Fed policy has not been systematically guided by a well-specified policy reaction function. And if we accept this, then we need to understand what we've seen in the post-pandemic experience is an illustration of an underlying challenge that has hampered monetary policy over time, not just at the Fed, but at many central banks. I'm going to summarize this as policymaker proclivity towards excessive discretion. Again, this goes back to 1962, Friedman's paper on whether we should have an independent central bank that was already mentioned this morning. Excessive reliance on discretion, insufficient guidance from policy rules is not a new challenge, of course. We know this. It has been a well-known problem on monetary policy, on designing monetary policy frameworks. And indeed, I want to walk you back to the 1990s when we had this discussion on can we find a way in the rules versus discretion debate to find a mechanism that will constrain unhelpful discretion and still provide reasonably good outcomes for the economy? This was the early days of the inflation targeting regime. Back then, Ben Bernanke and Rick Mishkin, as you will see here, advocated inflation targeting for the Fed, and they suggested that constraining discretion was one of the major advantages of the approach. And indeed, many of the changes that the Federal Reserve has adopted in the past 20 years can be seen as implementations of some features of the inflation targeting strategy, clearly starting with a 2% inflation target that was adopted in 2012. However, success in practice is determined by institutional factors and implementation details that sometimes are not details at all. Sometimes it's everything that matters. One factor that hinders success for the Fed compared to many other central banks is the formulation of its mandate. The Fed cannot do anything about that, but it is formulated in a manner that is difficult to implement. A literal interpretation of the mandate that says that the Fed should simultaneously deliver maximum employment price stability is just not feasible. So this must be interpreted in a manner that makes it workable. I want to put a contrast of that with legislation in most inflation targeting central banks that is more recent, 80s, 90s, 2000s, that actually recognizes price stability as the primary mandate for monetary policy and a precondition for monetary policy to contribute to very good outcomes on growth and employment. Now, interestingly, and this is something I want to highlight in the discussion on the evolution of the Fed strategy, before inflation targeting was adopted around the world, the Fed interpreted its mandate in this manner under chairs Volcker and Greenspan. I recall when I joined the Fed as a young economist, it was considered, let's say, unhelpful to discuss in public the fact that the Fed had a maximum employment mandate. And it was controversial when this would come up because it would raise uncomfortable questions for what policy should do. Instead, what we see happen in practice is that monetary policy was fairly systematic, in some ways, successful than in earlier years, because it focused on, I'm going to quote how Chair Greenspan summarized this towards the end of his tenure at the Fed. He said, quote, maximizing the probabilities of achieving our goals of price stability and the maximum sustainable economic growth that we associate with it. And this was the strategy that the Fed was following at the time. Since 2012, the Fed has become more explicit about the maximum employment of its mandate, and this creates some challenges. Unless something else constrains discretion, emphasizing maximum employment too much as part of what the Fed should be doing is going to create difficulties for the Fed. So how do we operate with this? Let's see that I have limited time, so I will just show you the slide very briefly right now. One way to actually supplement the implementation of inflation targeting is by using simple rules in addition to whatever else the central bank is doing as a method for constraining discretion. I highlight here on this slide an approach that was introduced by Jan Vikstad at the Norges Bank in 2005. When Jan had pointed at the time, you can do optimal control, various things with your model, also track some simple rules and be able to explain deviations when these deviations occur. This is something that can be easily be done. We know what characteristics of reasonable simple rules are. I highlight a few on the slides. We know them. I will not go over them. I will actually go on to illustrate two specific examples of rules that the Fed has been tracking internally. These are two policy rules that the staff has been presenting to the committee in the Blue Book and Teal Book, starting with the January 2004 meeting. And I want to simply highlight how different outcomes might have been if we had a public provision of this information at the time of the decision. So I simply have two rules here. These are the classic Taylor rule. We all know the natural growth targeting rule is a variant that is like a Manning growth targeting version of a Taylor rule that doesn't rely on star variables. Both of these rules are pretty robust depending on model configurations. Both of them have been tracked by the Fed from January 2004 until 2018, which is when the information we know. We can actually get the data, we can plot the data, we can see how these things behave. Now, we would have wanted to have this information to see what these rules suggested to committee members during the pandemic, and we don't have that. But what we can do is use other information. What I do in this slide is try to replicate these rules from the Fed by using the projections within quarter projection or three-quarter head projections as needed for the rules from the survey of professional forecasters. And I just want you to look at what these rules would have been suggesting in the post-pandemic recovery. Both of them, we know rules can disagree with each other. Both of them highlighted that the Fed was behind the curve. The Fed should have tightened policy considerably. Had the Fed been providing this information in the SEP every quarter, the Fed would have felt the need to explain why it deviated so much, or, my view, probably would have adjusted policy in a way that would have reduced the policy error. So it's my final slide for the next strategy review. I think we can push for this incremental improvement. I think the baseline should be to try to discipline discretion. This can be done with simple rules. Had this been done already, monetary policy would have been more resilient.
John, Mike, Hoover Institution, thank you very much. Charlie Plosser and I, the title of our paper is "The Fed's Strategic Approach to Monetary Policy Needs a Reboot." In summary, the Fed's original 2012 strategic plan was balanced and clear. And I might note, Charlie was a key architect of it when he was at the Fed. But following that period, the Fed's excessive worries about low inflation, the risk about collapsing inflationary expectations, and the effective lower bound really predetermined the 2019 strategic review and the new framework that was adopted in August of 2020. The result was an overly complex and asymmetric flexible average inflation targeting that favored higher inflation. The strategy put a higher priority on a broader employment mandate and effectively dropped preemptive tightening as a tool to manage inflationary expectations. And the strategy opened the door for greater discretion in the conduct of monetary policy. A month after the Fed adopted the program, Charlie and I wrote a paper entitled "The Murky Future of Monetary Policy." And we identified the flaws in the strategy and basically said it would be a matter of time before its flaws would be revealed. So with regard to the Fed's excessive worries about the low inflation and effective lower bound, coming out of the financial crisis, inflation remained low despite the Fed's zero interest rates, quantitative easing programs, and fiscal stimulus. And the Fed's ex post rationale was the Phillips curve was flatter than they had presumed. The expansion continued. The unemployment rate came down to 3.5%, but the Fed's worries mounted about the effective lower bound stemming once again from the low inflation, the risk of falling inflationary expectations, and the Fed's estimates of a secular decline in the neutral rate of interest. These fears, so the Fed's worries, we believe, were unsubstantiated by the data and driven by asymmetric fears. The fears of lower inflationary expectations were incorporated into specified models that confirm the downside risk of falling inflationary expectations. In fact, from 2006, following a sharp decline in oil prices in 2014-15 that lowered the headline rate towards zero, inflation in the 4 years 2016 through 19, the CPI averaged exactly 2%. The PCE inflation was 1.6, while inflationary expectations, as some people from earlier panels mentioned, the inflationary expectations were well anchored at 2%, and the Fed projected in its SEPs that inflation was going to rise to 2%. And there was no evidence at all that the low inflation was harming economic performance. So the strategic plan that the Fed undertook in 2019 was predetermined. The Fed's mind was set. There would be a makeup strategy to offset prior downside inflation misses. They would add flexibility to the 2% target. Some Fed members talked about opportunistic reinflation to pump up employment and anchor inflationary expectations to 2%. And, just to summarize things, at the Fed's June 2019 review symposium, Jay Powell's introductory remarks were 19 paragraphs long. 9 of them had to do with the effective lower bound. So the new strategy and its flaws. The flexible average inflation targeting, it was asymmetric, it was overly complex without any numeric guidelines. It favored higher inflation. It was really a time-varying expectations approach. And the strategy did not include any makeup strategy following a period of above 2% inflation, witness where we are now. The new strategy also included expanding its employment mandate to maximum inclusive employment, which, it sounds good, but maximum employment, as the 2012 strategy noted, it's unquantifiable, and it's affected by a lot of non-monetary factors. And so with the Fed's shift to saying it was going to respond to shortfalls rather than deviations, combined with their notion that the Phillips curve was flat, this basically deep-sixed preemptive tightening. And all in all, the strategy, it put a very heavy reliance on managing inflationary expectations and doing so through forward guidance. So how did the strategy perform? It contributed to the Fed's mistakes and higher inflation. The Fed's poor forecasts and failure to acknowledge the persistence of inflation were all based on the presumption that inflation would stay low, reflecting the same preconceived notions it had that led up to the strategy. It did not respond when inflationary expectations became unanchored, and reliance on forward guidance failed to manage inflationary expectations. We can come back to that. And this added up to a loss of credibility. Now, Fed Chair Powell has said there's an upcoming strategy review beginning later this year, and we have 5 basic suggestions. But our base for thinking about this is the Fed is seemingly adrift with regard to inflation and needs to really step back before it moves forward and address some basic issues. Our first suggestion is, when it conducts this strategic review, it should conduct a more thoughtful and thorough review of the inflation process, its dynamics, and how they relate to monetary policy tools. A time-varying Phillips curve is an inadequate basis for understanding inflation. And if we can't rely on the Phillips curve to be a reliable predictor, what is a reliable predictor or framework? The Fed should be analyzing factors that affect aggregate demand, fiscal policy, the monetary transmission mechanisms, how they might be influenced by IOER, changes in capital and liquidity requirements, asset purchases and the balance sheet, and other macro conditions. There needs to be more focus on nominal GDP as a broad measure of aggregate demand and money. Our second suggestion is the Fed needs to clarify its interpretation of its mandate. It needs to correct the asymmetries and complexities of the FAIT. It should consider returning to the clear 2% inflation target of the 2012 strategy. The Fed should be adding or consider adding a numeric target around, a numeric range around its 2% target to provide guidance to financial markets and the public about how it will respond when inflation deviates. It should also consider alternatives to explore systematic price level targeting, its pluses and minuses. And regarding the maximum inclusive employment objective, the Fed should restore its terminology that it's going to respond to deviations rather than shortfalls. Now, the third recommendation is, and Athanasios mentioned this, to consider systematic rules as guidelines in the conduct of policy. And this would avoid past mistakes in policy, improve clarity and transparency, and it just makes every sense in the world that the Fed needs to consider it. The fourth recommendation is the Fed should abandon the idea of forward guidance as an independent monetary policy tool. Simply put, references to systematic rules would help communicate understandable reaction function and provide more appropriate forward guidance. And then, John, I'll end quickly with my fifth point. The Fed should clarify and improve its quarterly summary of economic projections. And we have to remember, and the Fed should emphasize, that these quarterly forecast projections are conditional. They're conditional on appropriate monetary policy. So why are FOMC members' estimates of the appropriate rate, so why do they fail so frequently to achieve their desired outcomes? Why is there no dispersion of estimates? And of course, the SEP should include information on the balance sheet, which the Fed identifies as important. And then the final thought on the SEPs is, with such a poor track record in projecting, the Fed should consider an annual, not a quarterly, but an annual exercise that includes alternative projections to enhance risk management. And our concluding remarks, Charlie and I would say, we really encourage the Fed, when they undertake their new strategic review, to consider some of these suggestions. Thank you.
Thanks for having me. This is a very opportune time to perform a framework review for the Fed. These have been very eventful years in monetary policy the last few years. We've seen a bout of inflation in 2021 and 22, and then we've seen, quite remarkably, a disinflation without a recession. It's hard to overstate that achievement. Last time the Fed conducted a policy review, they had been so successful for so long at achieving rough price stability that the main worry was that they were undershooting by a few tenths of a percent, like Amy mentioned before, persistently. And I think it was lost on many people that were engaged in that debate just how much of a sign of success that debate was. Now, of course, the events of the last few years have brought some perspective and refocused the debate on bigger, more fundamental issues. The COVID recession and shock brought about a number of unusual developments in the economy. There was an enormous fiscal stimulus, and partly because of that, households built up a lot of excess savings, which then they started to spend down over time. There was a substantial reduction of labor supply that took quite a while to come back. And then there was this very unusual shift in demand away from services and towards goods that potentially created bottlenecks in the goods-producing sectors in the world economy, and certainly called for a temporary rise in the relative price of goods. Now, this is a figure that I like. Ignore the title. This is shipping costs in the world. This is the cost of shipping goods from Asia to Europe and from Asia to the United States. It's just giving you a sense for just how enormous this shock was. The prices of these shipping costs increased by a factor of 10. So clearly, the world economy was under a great amount of strain when it came to producing goods during this period. Now, did the Fed make a serious policy error in 2021? That's a common view. I think it's a view that is held by many people in this room. The Fed was certainly slow to react in 2021, and one can ask the question whether some aspects of the framework that was adopted in 2020 may have contributed to that slowness, and I think you can make a plausible case that that is in fact the case. So on the one hand, the flexible average inflation targets discussed how the Fed should allow inflation to rise above 2% for some time after it had persistently been below 2%. So that was actually prescribing patience in 2021, since it was in fact the case that the Fed had persistently undershot inflation in the previous years. But the Fed had also come under quite severe criticism in the years prior to COVID because of the preemptive tightening that started in 2015. So the Fed at the time, perhaps guided by measures of the natural rate of unemployment, thought that the economy was close to full employment and was starting to tighten policy. There was a lot of criticism of this. A lot of people thought that this prevented the economy from reaching the true full employment level. And it is true that measures of, at least in my view, it is true that measures of the natural rate of unemployment have persistently been too pessimistic. So I think this bout of criticism, it made its way to some extent into the framework that was adopted in 2020. That framework revised the operational definition of full employment. It adopted an asymmetric view of the labor market, where recessions were shortfalls, and you were thinking about shortfalls as opposed to deviations from a natural rate. And I think a lot of this came from skepticism about traditional estimates of the natural rate of unemployment. Now, I'm pretty sympathetic to this view, actually. So in this figure, I'm plotting the unemployment rate and the CBO's natural rate of unemployment measure. And you can see, for example, in the 1990s, where according to this measure, the unemployment rate is way below the natural rate. Okay, so the economy is supposed to be overheating. But in fact, Greenspan kind of looked away from this type of measure and allowed the economy to continue to expand. And we did not see much of inflationary pressures at the time. This happens again in the years prior to COVID. There again, the unemployment rate is way below the then lower natural rate estimates. And again, we didn't see much of inflationary pressures. In the third period, in the last few years, we've been operating way below these natural rate estimates, and that's been a period of disinflation, actually. So I think there might be something to the fact that these natural rate estimates are too high, and that in fact, the true full employment rate is much lower, might be around 3.5%. So I'm somewhat sympathetic to that critique, even though some of the implications that were drawn from it may not be correct. Now, in addition to those two things, the flexible average inflation targeting and the critique about the natural rate estimates, there were two other things that I think may have contributed to the slow reaction of the Fed in 2021. One was simply that Chair Powell was up for renomination in the fall of 2021, so a politically unpopular pivot right at that moment was perhaps more difficult than in usual times. And in addition to that, the Fed had led markets to believe that they would end QE before they started raising rates. And I think this was, in retrospect, a mistake that they made, and it slowed the reaction. And this led them to maintain this language in their statement in actually September and November of 2021. And you can see that this statement at the bottom there talks about how inflation, they're going to allow inflation to rise to 2% and is on track to moderately exceed 2% for some time now. Note that at this time inflation was actually 5.5%. And then they also talks about and emphasize the fact that the labor market should reach its maximal employment levels. And at the time, unemployment was 4.5%, and they probably thought that the unemployment rate had not reached maximal employment levels. Now, I was always under the impression at this time that it was kind of went without saying that this kind of a statement had an escape clause, that if inflation rose really high above 2%, this was no longer operational. But I was very surprised at the time that I talked to a lot of knowledgeable people and people that really follow this, and they did not interpret this as having an escape clause. It kind of, for me, it goes without saying that you have an escape clause in a statement like this. But this statement seems to have constrained the Fed in a way that led to a slower tightening. Okay, now, the one view is that they made this terrible mistake in 2021. Now let me tell a more positive view of what happened. Okay, so let's go back to the fact that after COVID, there was this huge shift in demand away from services and towards goods. Okay, and this calls for a big temporary increase in the relative price of goods. Now that can happen by the price of goods rising, by the prices of services falling, or some combination of those two. And in addition to that, the post-COVID inflation, a lot of it is coming from energy and food, so very volatile sectors, okay? Now, thinking about it in this case, now notice that prior to COVID, in normal times, there's essentially no inflation in goods. All of the inflation is services. And then over here, it's mostly goods and food and energy. Okay, and so the one way to think about the policy choice that the Fed faced at this time was, should we engineer a fall in the price of services to offset the rise of the price of goods? Is that the policy we should do? Okay, now if they had done that, that would have caused the big recession. And the question is, would that have been a good policy? Okay, an alternative view is for the Fed to say, no, we're not going to do that. We're just going to try to avoid the increase in the price of goods from spilling over into services. Okay, so if that's our policy and that works, then we get a temporary rise in inflation, and then inflation comes down when the relative price of services stops rising, and it might even reverse if the relative price of goods starts reverting. Okay, and we get a temporary bout of inflation, and we avoid the recession. Okay, so to me, this is actually what the Fed did. And from the viewpoint of simple models, this is actually a pretty sensible thing to do. This is optimal policy in some simple models. Okay? Now on the output side, it worked beautifully. No recession, extremely low sacrifice ratio in this disinflation. On the prices side, it didn't quite work, they didn't quite insulate the services inflation from the goods inflation. You see that the services inflation rises from about 1.5% to something like 3.5% when it peaks, and then is starting to come down. So it's not a A+ from this point of view, but I would say that it's a very successful way of conducting policy if that's what you're trying to do. Okay, so if we're coming back to the framework review, I think one of the key things that the Fed has to think about in conducting the framework review this time is how to think about the employment mandate. Okay? So I'm actually quite sympathetic to this plucking view that you should think of recessions as shortfalls and full employment is at the bottom of the picture, not in the middle of the picture, and we should be aiming for the bottom. Okay? So I'm sympathetic to that view. However, I don't think that it follows from that they should not conduct preemptive tightenings. Okay? I think preemptive tightening is essential. The monetary policy affects the economy with a lag. The economy is inertial. The Fed in that kind of a situation has to be thinking about conducting policy in such a way to bring about some kind of outcome 6 to 12 months out, and so it has to have on the table preemptive tightenings. Okay, so even if you believe in the plucking view of the world, preemptive tightening should not be off the table, and they should bring it back into their policy arsenal, preemptive tightenings. Another thing is flexible average inflation targeting. I suspect that many people in this room think that that should be on the chopping block. Okay, no, so I'm actually not necessarily of that opinion. The goal of flexible average inflation targeting was better anchoring long-run inflationary expectations. I think that is a central goal that they should be trying to achieve. Now, the specific concerns that they had in 2020 were kind of maybe somewhat idiosyncratic, having to do with these few tenths of a percent that they were under the target, and subsequent events have brought into perspective the fact that there are many other kinds of shocks that hit the economy that mean that there are other aspects of anchoring inflationary expectations. Now, I think we need to be humble here because I'm not sure we really know very well how to anchor inflationary expectations. Okay, so let me say one more thing before I finish. So we saw this disinflation with a very, very favorable sacrifice ratio. Why is that? I think it all comes down to credibility. Okay, so let's think of a simple case where a central bank is facing an adverse supply shock. And think of two central banks. Once the central bank would like to temporarily allow inflation to rise so as to avoid a recession, and then when the shock is over, inflation will come back down. Now, if the central bank has poor credibility and it allows inflation to rise, then inflation expectations are going to start rising. And inflation expectations are going to feed back to inflation, and the whole dynamics of inflation are going to get a life of their own, and the central bank is going to have to engineer a recession to get rid of things. And contrast that with a central bank that has strong credibility. It communicates to the market, we're going to allow this bout of inflation because it's a supply shock, but rest assured we're going to conduct policy in such a way that when the supply shock dissipates, inflation has come back down. Because it has very strong credibility, inflationary expectations are well anchored, and the dynamics of inflation are the same as the dynamics of the shock. I basically think this is what happened. This is a simplified story of what happened in COVID, but I think it illustrates a core message of what happened in COVID. The success of the Fed was to communicate, to conduct policy in such a way that the market kept believing in long-run price stability. And so here I have five-year forward break-even inflation, and you see that it has the heartbeat of a rock. It really is completely stable throughout the whole thing, and that's a major success that need not have been. If the Fed had not conducted policy in a credible way in 2022, raised rates in the sharp way that they did, they could have lost control of this situation, which they didn't.
I'm going to try to do two things. I'm going to try to answer John's questions about the strategy framework, and then I'm going to talk a little bit about what I plan to talk about, which is why I think the Fed is goofy to believe that the neutral rate is anything like 2.5% today. And the fact that the Fed can be so wrong about something important will tend to buttress the conclusions I'm going to reach about strategy. I'd suggest 5 things the Fed needs to understand as it does its strategy review. First, a return to humility. Look, we have a huge seismic shock about once a decade. The financial crisis, the pandemic, the oil shock, maybe the 1987 bubble, maybe a populist president, maybe the singularity. Roughly once a decade, something happens that causes there to be a big shock that changes everything. You can call it Knightian uncertainty. You can call it unknown unknowns. On top of that, the economics profession has no confidence about any of this. What have we heard in the last hour? We've heard the leading macro labor economist of the last 50 years tell us that in his view,
in 2010, we didn't have labor market slack because the unemployment rate was near the natural rate. We've heard a pillar of the next generation explain to us his view that the canonical feature of essentially all models, that the neutral rate or the natural rate was some average rate achieved over time, was not the right way to think about macroeconomics. So we have a stunning amount of uncertainty. What do you do when you have a stunning amount of uncertainty? You avoid making specific forecasts, committing yourself to specific rules, and you state general values and no more. John gave the terrific example of Mario Draghi on whatever it takes. My lesson on this came from my boss, Bob Rubin. We had issues in the 1990s when it was much more salient about how to think about the dollar. And, it's better to have a strong dollar for disinflation, strong country, better to have a weaker dollar for competitiveness. Everybody was saying all of this stuff. And the market was gyrating all over the place. And Bob said, our policy is a strong dollar is in the national interest. Was the dollar too strong? A strong dollar is in the national interest. Are you concerned about the excessive weakness of the yen? A strong dollar is in the national interest. And everybody thought we had a really shrewd, sage dollar policy, and dramatic fluctuations were attenuated. So number one, return to humility and don't forecast what you can't forecast. If somebody suggested that a company should every month have an earnings call where it forecast what its earnings were going to be month by month going forward, you could say that was like information and it was transparency and it would make a more efficient capital market. But somehow we'd all know that was a dumb idea and that monthly earnings would not improve the functioning of the US capital market. And I think it's an interesting question in economic theory why that is. But whatever the answer is, must have lessons for the proper conduct of monetary policy. Second, no forward guidance in normal contexts. Here's the truth about forward guidance in my view. The market doesn't believe it, because they probably shouldn't, because the Fed mostly doesn't live with its forward guidance. But the Fed takes it very seriously, and it therefore feels constrained 6 and 9 months later by its own forward guidance. It is only the Fed's forward guidance that explains why, when it was utterly obvious that it was necessary, that we didn't have tightening that would contribute to credibility as we went forward. 3, no QE except when necessary to maintain market functioning and liquidity. It's remarkable to me that nobody has mentioned the fact that unelected officials of the United States managed the US debt in a way that very substantially shortened the maturity of the debt that markets had to absorb of their own volition, in a way that cost the United States, depends on just how you estimate it, but $500 billion wouldn't be a terrible estimate. At a time when every corporate treasurer in America was terming out their debt to no substantial benefit. At the beginning of the pandemic, market stability, fine. By the time you got to 2021, no market stability case for any of that. No QE, one integrated monetary policy set by debt management policy set by the Treasury and the Fed. Number 4, no cacophony. Supreme Court's a pretty important institution. It doesn't have to publish minutes of its deliberations before 3 weeks or 5 years after it has its deliberations. The Treasury Department does not encourage every undersecretary, every assistant secretary to give their own speech about how they see the issues facing the department. We have a set of institutions, mostly encouraged by academics, as best I can tell, that create a huge cacophony around monetary policy to, I think, no observable benefit in terms of reduced volatility, reduced predictability, or anything else. And last, no specific numerical targets. I thought in 2011 that I advised President Obama that he should not support the Fed's judgment of a 2% inflation target because I didn't know what was going to happen, and I thought that 1% inflation target might be better at some point in the future, or a 3% inflation target might be better. And if you announced a target, you were either going to be constrained by that target away from what was optimal, or you were going to be sacrificing your credibility. I am aware of no evidence that any of this apparatus has meaningfully served objectives. It is certainly true that monetary policy has achieved a much greater credibility than it had in 1979. That is absolutely the case. But I believe the reasons for that are the social consensus that was developed about how terrible the management of monetary policy was in the late 1970s, and the credibility of key individuals like Paul Volcker and then Alan Greenspan and their counterparts internationally. So I believe if you were really trying to make monetary policy right, you would have a quite radical change in the approach that's currently taken. I am just about through my time, so I'm not going to run through my slideshow. I will only summarize it in 3 minutes by saying that the Federal Reserve has the same belief that it had about the neutral interest rate 3 years ago. It has moved by all of 10 basis points. Here are 4 reasons for thinking that's crazy. 1, the market's view about the long-run neutral real interest rate has risen by about 2 percentage points or more since that interval. And if you make adjustments for the term premium and don't just look at the forward rate, the increase is greater than 2%. 2, the economy is going strong with financial conditions that, as measured, are looser than they were before tightening started after a 5 percentage point increase in the interest rate. You know, there's a research area to be pursued, which is that if you read Milton Friedman's presidential address it's all about an analogy between the neutral unemployment rate, or the natural unemployment rate, and the Fixelian real interest rate. If it's right that the natural unemployment rate follows the actual unemployment rate, as we heard earlier, maybe there are respects in which the neutral interest rate follows the actual interest rate as well. I'm not sure, but strong economy, loose financial conditions, high interest rates has to tell you something about neutral interest rates. Third, the model. We have had a structural substantial shock in fiscal policy. I think it's perhaps 3% of GDP. Leave aside Cochrane doctrines about how that's going to present value of the nominal and deficits and all that stuff, and how that's going to be inflationary. That stuff might be right. I just don't know. But take the most conservative view and take a Valerie Ramey estimate of the slope of the IS curve, and you'll conclude, I believe, that that 3% increase in the deficit adds 1.5 or more % to the real interest rate. And that's before you get to green investment and a variety of other structural shocks that are increasing investment. So look at the model, look at what's happening to the real economy, look at the market judgment. It's just hard to believe that the neutral interest rate isn't substantially higher than it used to be. Maybe I'm wrong. I think that I'm much more likely to be right than wrong, but that means I'm 75% confident in my judgment. But surely we shouldn't be automating processes that are based on estimates of things like this that don't change. And so there's no real alternative to extensive study, academic debate, but policymaking by judgment, not by straitjacket.
Let's get some questions.
David Papel. I want to take issue with some of the view of fate being an important part of the increase of inflation. And I think if you look at March of 2021, the time of the SEP, the time of the FOMC meeting, that annual core PCE inflation was 1.7%. The forecast for the end of 2021 was 2%. So that's clearly, you're in a fate world there. By June of 2021, the numbers had gone to 3.5% for annual core PC inflation and 3% for the forecast for the end of 2021. You've blasted through fate. It was completely irrelevant, and it stayed irrelevant. So then if you look at when people talk about when the Fed started deviations, and my work with Alexandra does this, lots and lots of people do this. It's really starting September of 2021. So I don't see where fate had anything whatsoever to do with the rise in inflation.
Go to Pat Kehoe behind you.
For Jón Steinsson. You had some interesting pictures, and so did Emmy, about inflation in goods versus services. But at one point you alluded to something, maybe the Fed should have targeted one versus the other. Just mechanically, what were you thinking about? How does the Fed differentially affect the inflation rate of good versus services?
We're going to Sebastian Edwards.
Thank you. I know that this is a panel on the Fed, but I want to ask the panel or anyone, what about the dollar? And in particular, the dollar-yen rate. it's astounding. The only similar exchange rate is the Mexican peso dollar rate, but I don't want you to focus on that. Is there anything about the global economy, in particular exchange rates, that bothers you, or that the Fed, in rethinking the strategy, should take into account, in particular, given that we're talking today about global monetary policy going back on track?
Go forward to Bob Hall.
So first of all, I deny that I'm the hypothetical economist that Larry mentioned. Anyway, seriously, let's take Larry's point and look at it carefully. Hypothetically, if the unemployment rate is 10%, some disaster comparable to what happened in 2009 has really caused major dislocation of the economy, and comparable to what being in a war does, and then ask whether it's plausible that means that there's the only way we can get out of that is a patient rebuilding of the economy. That's the hypothesis. If the unemployment rate just were suddenly, for no reason and no disaster, to turn out to be 10%, hypothetically, then obviously this wouldn't apply. So I recognize the debating value of your point. As usual, you went directly to a potential weak point, but I think it's plausible, as plausible as the rest of the proposition that we're talking about.
Go over to this side of the room. Mike Borda first.
I just have a quick question for Jón Steinsson. So, I like the plucking model, and I worked with it quite a bit in the past. So how do you square a plucking model with preemptive monetary policy? I'd like to understand how that works.
Thank you, Jim Bullard. So in his role of provocateur, Larry Summers has suggested two outrageous things here, which I want to correct. One is to get rid of the 2% target. So it's become an international standard to have the 2% target all around the world, wildly successful. I think if the leading economy dropped the target, you'd cause chaos around the world. You'd be back to the 1970s. So I do not think dropping the numerical target is a good idea. And on the cacophony issue, I don't think you can stop what's happened with global monetary policy. Most of the people that are talking are not the members of the committee, but are major investment houses and others that are talking, and many of in this room that are talking, and former policymakers in this room that are, including me, that are talking, sort of on a 24-hour-a-day, 365-day-a-year debate about American monetary policy. To pull the policymakers out of that would be worse, I think, because you want the actual policymakers to be talking about what the policy actually is, as opposed to everyone else speculating about what the policy actually is. So I think it's good to have the big committee, and also for the ECB to have a big committee, and to be having the policymakers sort of fighting back or releasing the tension that's being driven by private sector commentary on what monetary policy should be doing or is doing.
Let's go back to Andy Filardo.
So in terms of the review that the Fed is looking forward to, I wonder if there's a discussion to be had about going negative with interest rates. I mean, the rest of the world has moved there, and it seems like the Fed has preferred low for long. And it seems to me that low for long can create lots of distortions, especially in the way policy markets think, the way financial markets think, while a quick, sharp decline in interest rates, and then hopefully the issues get resolved and you pick them back up, is less distortionary. So I wonder if it's time for the Fed to go negative at some point.
Steve Davis, then Darrell Duffy.
Back to Larry Summers' comments. So I had 2 points. One, presumably there's an intermediate, and I'd like to hear intermediate suggestion, which is even if you keep a 2% target, you don't have to have all these forward guidance, projections, numerical thing. I think that's what I understand to be part of your argument. But I would like to hear your vision of if we move towards your approach, more humility, focus on main objectives without being too precise about it, too much talking about it all the time. I'd like to hear your ideas about how we will facilitate an efficient evaluation of monetary policy performance in that kind of, because always, you can always say, well, we got 5% inflation this year because something bad happened and it wasn't us. And I don't want to go through another 1970s where it takes a long time to have a course correction in terms of popular perception, popular desire to fight inflation and to have the right person in the Fed. So I'd just like to hear your thoughts on that.
Daryl?
We've just seen a remarkable divergence of advice for the Fed, all compellingly presented. Is it plausible that the Fed is going to be able to sort this over the next 16 months or so? And if not, is there risks associated with coming up with a monetary policy framework by the end of next year?
Well, you go back to Volcker Wieland, I'll say they're going to ignore all of us, so don't worry about it. Volcker and then Bob King.
Thank you, Volker Wieland, Goethe University, Frankfurt. Just one quick question on the shortfalls idea. It seems to me also, I mean, we have some of the policy rules with the shortfalls element. It seems to me that introduces an inflation bias. I mean, if you have basically, say, if you would run this through a macro model with symmetric shocks, and on average, you only respond to shortfalls, then you get an average inflation bias. I mean, there was work by Alex Kuckerman years ago showing that with asymmetric output gaps in the policy rule. So, I mean, surely the Fed must have looked at that. Why would they want such an inflation bias?
Bob King for the last question.
So I want to take the bait on something that Larry Summers said. And in particular, I want to envision, as he did, going back to the 1990s. And so at that time, we had Alan Greenspan, who was the chair. His FOMC was notable in that it had systematic discussions about what the long-run goal for U.S. inflation ought to be, that involved presentations by Al Broadus, Janet Yellen. They reasoned out that they could live with something that was like 2%. And then some of the many voices talking at the time brought that 2% to the public, even though Alan Greenspan advised against it. Another feature of that period was that the Taylor rule became a reference point within the committee for thinking about the appropriate setting of monetary policy and the responses to various kinds of events. The third thing that was characteristic of that period was that during the 2000s, Greenspan began to signal the path of interest rates to the financial markets. And if one looks at the behavior of Fed funds futures and Eurodollar futures, it was very clear that after early 2000s, the markets sort of tuned in to what the Greenspan Fed was communicating, and you plot the things in there stunningly similar to the events that ultimately transpired, particularly during the tightening cycle in 2005, et cetera. So Larry, which of those things do you want to walk away from? Do you want to walk away from the idea that the central bank ought to have an internal goal? Do you want the staff not to produce Taylor rule calculations and use those as a focal point for some of the internal discussions? And do you want to stop talking to the markets so that the markets won't have expectations over the course of the coming 2 years about the path of short-term interest rates?
So we are now 5 minutes over time, and there is no time inflation, sorry. So try to be brief, and let's come down this way and say what you got to say, and then we'll go on.
Thanks. So it's, I will be very brief because I didn't have any directed questions at me. I'm going to address a couple of the questions that came up. Forward-looking or reactive? Actually, I agree with John. We need to be forward-looking in policy, but forward-looking is meant to capture the professionals and the Fed staff's ability to do excellent nowcasting and short-term forecasting. So identifying these trends, like 1 quarter ahead, much better to respond to that than waiting for the historical data released with lag and just have a completely passive policy. So a little bit forward-looking actually can go a long way towards improving policy. But we need to be robust. So we should not be guiding policy guided too much, as Larry pointed out, by stars that we don't know what they are. But this is the whole point of running robustness exercises so that we can have a benchmark rule that would be more robust than otherwise. And I want to say something about the 2% target. The adoption by the Fed of the 2% precise definition of price stability as a goal has been, in my view, the most important improvement in the Fed strategy in the last half century. And I agree with Jim Bullard, it would be a terrible mistake to move away from that. And I think that overall, since that adoption, the Fed has done a wonderful job. I mean, the fact that we were complaining about missing inflation by 2 or 0.3% before the pandemic, I agree with the interpretation that that was a sign that was pretty good. What I would have wanted I would have wanted a strategy that actually makes that robust going forward. I would have wanted a strategy that would not allow the errors that happened later on with the forward guidance that was highlighted by many of us and so forth.
Charlie?
I just want to make one point. I think that one of the things that concerned me most about the FAIT, if the Fed had adopted a price level target, I might have been happy with that if it had been symmetric. But what they did was they put out a model that depended on the Fed's ability to manage time-varying inflation expectations. In the short run or intermediate term, they wanted higher than 2% inflation. And that had to be credible or it wasn't going to solve the zero lower bound problem. So they had to manage this in a way, and then they declared that they still wanted average inflation to be 2%. Well, if you only offset undershoots, you can't have an average. So what did Powell say? Oh, we're not going to be hung up on a mathematical definition of average. You know, it's going to be flexible. It's all discretion. They make no commitment to anything particularly. And I think that very exercise damaged their own credibility about their commitment and their ability to manage expectations. And as Larry said, and as Mickey said, they can't manage expectations as if it were an independent tool of monetary policy. They can only manage it in connection with their commitments to take policy actions in the process. And so I think that has been I don't want to say a false flag, a false dream that many people have used, and I think it's misguided. So I very much agree with a lot of what Larry said, actually. Not some things, but the Fed needs to step back. We need some more humility about what we are able to accomplish and more understanding of what the mechanisms are that allow that to happen. And Mickey and I said in our paper that inflation dynamics, as we currently understand them, are adrift. We don't know a lot about them. So what we need is good policies, committed policies that are robust and not try to fine-tune things in a way for which we are unable to be successful. And so that's why we say we need to take a step back, exercise a little humility, look for robust guidelines and stick to them, and particularly those that we can actually achieve.
Mickey, briefly?
Yeah, just two quick points. David, in the first half of 2021 and ongoing, while the Fed was focusing on supply shocks and distribution problems, nominal GDP, the broadest measure of aggregate demand, was accelerating at its fastest pace in modern US history, and it has continued to accelerate. So that's what generated the excess demand. And I think that instead of focusing on maybe trying to push down service prices because goods prices have gone up, they should just focus on what they're capable of doing, that is aggregate demand. Second point in response to Sebastian, as Larry said, strong growth, but we also have strong productivity, and the US has significantly higher potential growth than, say, Europe or Japan. So that pushes up, the higher real growth pushes up real rate of interest and also real rate of exchange. And the only reason why the Mexican peso is outperforming is it has tremendous capital inflows and expected rates of return on peso-denominated, assets is high. So it's all positive.
John.
Yeah, Michael asked about plucking and preemptive tightening, and this is also related to Volker Wieland's question about shortfalls and biases. So the plucking model or the plucking view of the world is a nonlinear world, okay? So we're much more comfortable with linear, like operating in linear frameworks, and operating in linear frameworks is simple in certain ways. Operating in nonlinear frameworks is more complicated. The policy has to be nonlinear to accommodate that. And it's true that preemptive tightenings are going to be more complicated to think about in a nonlinear world. You don't know where the kink is, so you don't know exactly when you want to do this preempting. That's tough about living in a nonlinear world. But it doesn't mean that the principle of conducting preemptive tightenings is still a valid thing you need to be thinking about. It's just very hard to know when you should do it. That's hard, but if the world really is nonlinear, it's harder to perform policy, but I still think the principle applies. There's been a lot of criticism of forward guidance on the panel, and on that context, I'm a big believer in forward guidance. I want to bring you guys back to the hair plot that Emmy showed us on the last panel. One of the things that was very striking in that figure is that the market never had a clue what the Fed was doing. The Fed was in the middle of a major easing cycle, like in 2001, and the market couldn't forecast even one more easing. Or in 2008, in the middle of 2008, the world is collapsing and the market is not forecasting one more easing. Okay, so the market doesn't have a clue what is going on until the Fed starts doing forward guidance. Then finally, the market can the Fed is telling them what they expect they're going to do, and yes, the market can tell what is going to happen a little bit better, not perfectly. Sometimes we have mistakes, sometimes you get into corners and you've boxed yourself in, but at least you can transmit interest rate expectations into longer term interest rates. And if you want to operate on the 30-year mortgage rate and bank lending rates at 5 and 10 years, this is a really valuable thing to do. And I think that's what forward guidance is about and why it's important. I very much agree with Jim on the cacophony. I also agree with Athanasios on the basic fact that monetary policy has been spectacular in a historical perspective over the last 35 years. So we don't want to break what is, you don't want to break something that doesn't need fixing. Okay, so things are pretty good, I think, in terms of monetary policy if you think over a historical perspective. And so I'm not really sure we should do something super radical.
And for the last word, Larry.
Bob, I think you misunderstood me. you might well be right in your view. There's a good chance you're right in my view. My point is the fact that you have your view and it's so different from many standard views is a reminder that we all need to be humble about our understanding of the economy. And my intent was not to criticize your view. The dollar is an interesting phenomenon. I think the least remarked on thing about the global economy that's really important to me is if you look at the fraction of stock market value that is US companies, it is stunningly high relative to anybody that anything could have expected 10 or 20 years ago. And that phenomenon and the strength of the dollar, I suspect, are very strongly related. Plucking, I'll leave it to John to do it. I am sure that you can make a case that just because excess demand creating excess output isn't the right way to think about excess demand, it's still a good idea to preempt excess demand, especially if you believe it will all go into inflation rather than only some of it going into inflation rather than output. So I'm sure you can square plucking with preemption. The cacophony, maybe this theory's right, that since there are a lot of other people who will comment on policy, a lot of other policymakers need to comment. Maybe that's a good theory. It's not a theory we as a society apply in any other area. There are a lot of people commenting on policy towards the Middle East, but we don't decide that every part of the government and every random assistant secretary or deputy assistant secretary should be giving a speech every 3 weeks with their views. In general, we weight coherence from authorities. No company allows full transparency of its deliberations. So the notion of presidents don't allow the minutes of their National Security Council meetings to be released even 10 years later. So maybe there's something very special about monetary policy, or maybe monetary policy people have figured it out and the rest of the world hasn't. But the way we think about the cacophony issue with respect to monetary policy is very different than the way we think about any other issue. The 2% target, look, the question is not whether having a regime with stability and having a bunch of research projects done within the Fed is a good idea. Of course, those things are good ideas. The question is whether defining a specific numerical target is a good idea and enshrining it as a principle. My best guess is that over the next 3 years, one of two things will happen. Either we'll end up settling out as a 2 3/4, 3% inflation country, or in pursuit of 2%, because of extra actions taken in pursuit of 2%, we'll have a fairly serious recession. But one of those two things will happen, and that we will end up in an unpleasant place is, I think, made more likely by having enshrined as firmly as we have the 2% target. I agree with you that if it were my responsibility to actually make policy rather than to influence policy by commenting, that I'd want to be very careful about the consequences and the way in which the adjustment was managed, given that we had announced a 2% target and it had become substantially enshrined. And I feel the same way about all this stuff. I mean, it's one thing to say that dot plots are a bad idea. It's another thing to say that having instituted the principle of dot plots, you're now going to remove dot plots. And one of the important issues that I probably should have highlighted is that there's a kind of ratchet in formal procedure. Whenever you put in place a new transparency thing, you can never take it away if it turns out to be a bad idea. And that's another reason to be cautious about transparency. And I'll conclude with this, because maybe I haven't been quite outrageous enough. I think there's a 50% chance that the United States is going to elect a Juan Perón equivalent as its next president. If it does, inflation is going to be an important part of the reason that it happened. Whatever your detailed and nuanced arguments about flexible average inflation targeting and the ways in which it did or did not contribute to any of this, I believe that if Alan Greenspan or Paul Volcker had been chairman of the Fed in 2021, we would not have generated nearly as much inflation as we did. And I have no doubt that they share my views on these points about forward guidance, cacophony, specific numerical targets, QE, and all of that. And I think that's something that is worth considering for those of you who are enthusiastic about all the apparatus.
Thank you, panel. Thank you, questioners. Everybody.